What if I told you that there was a way to generate $129,900 in retirement income and pay nothing in taxes? Sounds like a scam, right? Sounds fake? It's not. And I'm going to walk you through a real life case study about how you could generate almost $130,000 in retirement income and pay nothing in taxes. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning. Today, I'm only going to be talking about federal taxes just because there's 50 different tax codes with different tax legislation in each state that could affect how this income is taxed. So for now, let's focus on how you can reduce your federal taxes. This is really important to pay attention to because federal taxes might be one of your biggest retirement expenses. And what if you could reduce that, potentially even to zero? Let's jump into the case study. I thought it would be helpful to first go through what it would be like to earn $129,900 in wages, like if you're working, and how that would differ from retirement when you have better control over your tax bracket. So let's look at an example here where you earn wages of $129,900. And these just are Susie and Gabe sample as our sample client here. And we'll scroll down to see what this looks like. So in this scenario, we're going to assume that there's no other dividends, taxable interest, anything else, just to give you an idea purely of what this would look like in terms of income. And with this, you can see with the standard deduction, so I'm going to assume that they are over 65. So there's a standard deduction of $30,000 for married filing jointly. And because they're both over 65, they're each going to get $1,600. And that's how we arrive at that $33,200. So that's going to be subtracted out from their adjusted gross income to arrive at taxable income of $96,700. In this scenario, they're going to pay total tax of $11,127. But that's not all the tax that they're going to pay. That's really important to know here, that they are actually going to pay more than that because that's going to include FICA taxes while they're working. So if we scroll down here and see the amount of FICA taxes they're paying, this is Social Security and Medicare, combined, they're paying over $21,000 for taxes off of an income of $129,900. So a pretty steep tax bill in this situation. What would this look like if they were to be retired when they have better control over their income? So let's go ahead and add a situation here where they are going to collect Social Security and dividends. So in this scenario, let's assume that Susie and Gabe sample that they have the opportunity to claim Social Security benefits, but they get to control when they do that or when they start benefits. They're inclined to claim a little bit earlier than they normally would, but after we go through analysis, they may change their mind. So in terms of their assets, they have $500,000 in a brokerage account. And we're going to assume $250,000 of that is cost basis, or what they use to purchase the investment. So only about half of it is going to show up as capital gains when they go to sell. They also have $1 million in an IRA, and they have about $100,000 in a Roth IRA. And the extra layer of complexity we're going to add here that we're going to come back to at the end of this video is that they expect $1 million of an inheritance in the future. And this is all coming via an IRA, so an inherited IRA. And because of the new rules that they're experiencing, this money actually has to be distributed out within 10 years, and they have to take annual distributions from it. So we're going to put that on pause for a second and come back to that inheritance to see how this impacts the tax planning. But for now, let's assume that their brokerage account has a dividend yield of 3%. So if we look at their qualified dividends, we're going to assume all of this is qualified instead of ordinary income. So they're going to have $15,000 of qualified dividends, and we model, because they said, hey, I want to claim Social Security sooner. One of them's going to delay until a little bit later. In this scenario, one of them would claim $28,000 a year in benefits. What would that look like in terms of taxable income though? So if we scroll down, we'll see their total income is $15,000. And I want to pay attention to here for a second that you can see that their taxable Social Security is only zero. And by only, I mean, it's only zero. And the reason for that is a lot of people aren't familiar with the rules that Social Security can actually be anywhere from 0 to 85% taxable. If we look at their Social Security, only a certain amount of that is going to be taxable. And we can see that with Social Security. So the important thing to pay attention to with Social Security is provisional income, which provisional income is going to be your adjusted gross income plus any tax exempt income and half of your Social Security benefits. So if you're married filing jointly and your provisional income is less than $32,000, well, it could be potentially 0% taxable. between 32 and 44,000, up to 50% taxable, and then above that, 44,000, 85% taxable. So that's important to keep in mind that depending on your other sources of income, Social Security can potentially not be taxable at all. Like if we go back to this example here, we can see in this situation, Social Security is not taxable. So if we scroll down in terms of total income, you can see it's less than what they're actually taking in. When we take that standard deduction now, we're not actually fully utilizing it. What we end up with is not paying any money in taxes. So they say, hey, that sounds like a good situation. I'd like to do that, but wait, hold on a second. $0 in taxes isn't necessarily always the goal if we could recognize more income. So let's take this a step further. And let's say that in this situation, we're going to have the same $15,000 of qualified dividends here, $28,000 of Social Security, but you'll see here the change. We went from $0 of taxable Social Security to $14,500. So what happened here is the additional income that we recognized with long-term capital gains. We assumed that they recognized $25,000. They pulled out $50,000. Remember that about half of it was going to be taxable to them. So they needed to take a withdrawal in this hypothetical example. And that ended up actually making more of their Social Security taxable, which isn't always a bad thing. But in their situation, as I mentioned earlier, they wanted to optimize benefits for Social Security, but also wanted to claim it early. So after this conversation, they thought, what would happen if I didn't claim Social Security early? What if I waited a little bit longer because we went through the Social Security report and it optimized benefits by them waiting a little bit? If you're interested in how this could apply to you, click the link in the description down below and schedule a time with me and we can talk about how this could help you. And in this situation, we took this a step further and we said, okay, what happens if we didn't claim our Social Security early in retirement? And what if we just lived off the brokerage assets for now? So looking at the brokerage assets, we have the $15,000 of qualified dividends. So that was that roughly 3% dividend yield. These were all qualified. The Social Security went away in this situation. And then they needed to recognize income. And I wanted to model them a scenario where what's the maximum that they could recognize in long-term capital gains and pay nothing? $0 in federal taxes. And we calculated that to be almost $115,000 worth of long-term capital gains. So this would be north of $200,000 if they needed a withdrawal, or maybe we were just talking about tax gain harvesting in the 0% long-term capital gains bracket. But what's interesting about this point here is if we scroll down, we can see their total income has now jumped to $129,900. Same for their adjusted gross income. They're getting that same standard deduction that we talked about earlier, which brings their taxable income to $96,700. And interestingly, what you'll see here is they're paying nothing in taxes. Why is that? Let's pause for a second and go back to the different scenarios here. So in this scenario, this was the Social Security plus dividends. So that $15,000 plus the $28,000. What ended up happening there? We saw that none of their Social Security was taxable. And the reason for that was because they stayed within this ordinary income tax bracket, and there was nothing here in terms of Social Security taxation. So, what does that mean in the next example where they had the long-term capital gains? This will start to make a little more sense. So we saw that their taxable Social Security income went up in that situation. They were paying nothing for their ordinary income because they didn't have any dollars that were being taxed that way. And if we scroll down, we can see in the 0% long-term capital gains bracket, they had some taxable income here, but they were paying nothing because they were in that 0% long-term capital gains bracket. And then here's where we can see the taxation of the Social Security that we couldn't see in the previous example, is that we mentioned these tax brackets earlier with Social Security, but their combined income was about $51,000, so their taxable percentage of Social Security was about 52%. And as I mentioned with provisional income earlier, this is how it was calculated. We had the dividends plus the long-term capital gains, so the $15,000 plus the $25,000 equaled that $40,000. They didn't have any tax exempt income that we needed to add back in. And then we took half of their Social Security benefits, or $14,000. And in that situation, it was that $54,000. So you can see not all of their Social Security is being taxed, but some of it is being taxed in that situation. And that's important to keep in mind that if we go back, how that changes. So they decided to not claim Social Security because they didn't like the taxation of that, and they wanted more flexibility to recognize income and pay no taxes. So after we went through this and they saw all the long-term capital gains that they could recognize from this portfolio, they thought, are there any other sources of income that we could? So we walked them through, what would it be like if we did a Roth conversion in tandem with long-term capital gains? And this was an interesting scenario. So now they have the option or flexibility to do one or both. So we took it over and said, okay, $15,000 of qualified dividends again. And in this situation, we're going to do a small Roth conversion, $29,200 exactly. And we're going to recognize $85,700 in long-term capital gains. What would this mean in terms of taxation? So just a different way to generate income. What if we didn't want all this to be long-term capital gains or some combination of Social Security and dividends? What would this look like? And you can see we came to the same exact level of income that we did before, $129,900, same standard deduction. So we arrive at the same taxable income. But in this situation, we've moved some money that was pre-tax or ordinary income, and we've moved it to a Roth account. So where the money can grow tax-free for as long as they're alive. What does that mean in terms of taxes? Well, you can see that they paid nothing in taxes. And the reason for that might surprise you a little bit. So in this situation, you can see standard deduction is here. All these numbers that I was referencing earlier shows up at this report, but they pay $0 in taxes. Well, why is that? We can see their ordinary income, it's still at zero. And the reason for this is long-term capital gains get stacked on top of ordinary income. So we're filling first with the Roth conversion, and then from there, we're adding the capital gains on top of that. So we've done that very, very small Roth conversion, and they're paying no tax on that. And then what happens on top of that is here you can see with the long-term capital gains, we have some taxable income, we have some qualified income, but we're not paying any tax on that. And that's because they're still in the 0% capital gains bracket. So again, we filled it with that small Roth conversion, and then the capital gains are getting stacked on top of that. And this is really helpful for them because they can recognize different sources of income and pay no tax this year. So this is a very powerful situation where we've taken them up to the top of the 0% long-term capital gains bracket. We've moved some money that they got a tax deduction for to a tax-free account and paid no tax. This is the power of having different types of accounts in retirement. You can, in a way, create your own tax bracket. And I know that sounds very strange because when we're working, we just receive that income and there's nothing we can really do about it. We saw that situation earlier where we're paying north of $20,000, where in this situation, we recognize the same income and different types of income to pay nothing in federal taxes. So this is the power of tax planning, that if you have different types of accounts, you can choose how you structure that income, and you can combine that with Social Security claiming strategies, pension and how that's getting taken out, or IRA distributions. We talked about a Roth conversion here, but maybe they just want to take that money out if they wanted to for spending purposes. I'm not dictating how they do this. It's just showing you the power of how we can recognize different sources of income and create your own tax bracket in retirement. You have a lot more flexibility if you're proactive about it. And that's the key there, if you're proactive about it. And in my experience, a lot of people are not proactive about tax planning. Now, we could stop here and they could do the small Roth conversion, or they could do a ton of money in capital gains that they recognize this year. They have flexibility, we saw that. But the bigger picture is, how do we reduce their lifetime taxes? And that's not a question a lot of people are asking, but it is a question that you should be asking. And the reason for that is if we ignore what could come down in the future, we're setting ourselves up to potentially pay higher future tax rates. Now, I mentioned at the beginning of this video that they expect an inheritance later on. And this is really important because money is going to be forced upon them. So I was talking about how you can create your own tax bracket, but that becomes an issue if more money is forced to you. Now, that's not a bad situation. Obviously, more money is better. But if we knew that that had a high likelihood of happening, what we could start to talk about in more detail is doing larger Roth conversions, because we know in their situation, or we feel confident that they're going to receive this large inheritance. Money's going to get pushed out. It could be north of $100,000 per year. And they already have a pretty sizable IRA balance. So if we add up their Social Security, IRA balance, and their future requirement minimum distributions, plus the required minimum distributions from the inheritance or the inherited IRA, that may bump them into a much higher bracket later on, in which case they might want to consider much larger Roth conversions today to help smooth out the taxes that they pay, because they might be comfortable paying nothing now, but that might push them into the 33% or the 24%, some higher bracket later on. We don't know exactly what that will be. Whereas today, maybe they could pay 12 or 22 or maybe go up to 24% and be comfortable paying that tax to hopefully not be bumped into a higher tax bracket when they're older and when they receive that inheritance. Plus, they don't know what's going to happen with tax rates. So that's how they can start to plan around taxes later in life now. And I know a lot of people ignore that because they think, hey, I'll just pay whatever comes. But in my experience, most people want to reduce the amount that they give the government. And for a lot of people, that means proactive tax planning today, not just in the future, and not necessarily trying to reduce their tax bill as much as possible in the current year. So this could be looking at things like Roth conversions, capital gain harvesting. So maybe they don't need all of that money with the capital gains, but we can choose to recognize it every year. Maybe we rotate between Roth conversions and recognizing long-term capital gains. Maybe they want to hedge their tax rate, but they also want to enjoy some tax-free retirement income. So there's lots of different options and different approaches and strategies to figure out how to reduce their tax bill. But the key is trying to figure out how to do it over their lifetime and not just in the current year. I want you to ask the question, how do I minimize taxes over my lifetime? And then go out and try to figure out what's the best way to do that for you, not necessarily in the current year. Hopefully you learned something today. And if you enjoy this type of content, click the like button and subscribe to be notified of future videos. Thanks for watching. Enjoy.